What is up? This is the Working Investor. In this video, I'm going to tell you why I sold CHPY and GPTY. It sounds like I'm selling everything income related these days. And we're going to talk about what I've already done with the proceeds of selling CHPY and GPTY. And I believe that with less risk on the table, I can actually put myself in a position where I can outperform with sitting on more cash. As always, nothing here is financial, tax, legal advice, or losing strategy advice. This is purely for fun and entertainment purposes. And excuse me, I have a little bit of a cold, so I sound a little funny. Let's get into the video. So the big reason is that I'm having some restructuring within my portfolio. My strategy is evolving beyond just income. I'm kind of shifting to a multi-asset portfolio. There's like the Ray Dalio portfolio. There's the all-weather portfolio. There's the permanent portfolio. And there's the golden butterfly portfolio. What you see in the theme with all these different portfolios that they survive more than one type of market cycle. There are equity cycles. There are cycles that equities do very well, and there are actually sometimes even lost decades where the stock crashes and it takes about 10 years for it to come back up. And if you're 100% in equities, of course, there's always little nuances of how you tilt in equities. It's good to have your feet in different, you don't want to have all your apples in one basket. So gold can actually save you from crushing, or treasuries or other cash equivalents, or non-correlated assets, or let's say managed futures that could be morphing between different things. And you're going to hear me talk a lot about this in some future videos. I'm just giving you a mindset. I'm giving you a hint to where my mindset is heading towards. Because I talk a lot about stack risk parity, and then this is like my next evolution of, I was kind of heading in this direction, but now I'm heading here more. I still love high income, of course, like anybody else. But so my next thing is, let's break down GPTY, right? That's from YieldMax. That's their AI sector high income. And wait, I talked about this. I used CHAT, CHAT ticker symbol, is from Roundhill. And that's just a basket that holds a lot of, AI revolutionary. It's a thematic ETFs on AI, but it doesn't do any cover calls or call credit spreads. There's no capped upside. So it's pure momentum from the AI world, the theme. And here you can see a head-to-head comparison between GPTY and SHAT. And I looked from the inception of, GPTY came out somewhere in the January range of 2025. So I went exact date of inception all the way today, which is around Thanksgiving time. And you can see that SHAT has performed double. So and this is total returns with all the dividends included, up market and down market, everything, and in between. And you can see right here in the chart, it was tracking really nice. And then there was a massive divergence where, GPTY got left in the dust. And I mentioned this in my other videos. And of course, it's to be expected. Cover call ETFs, like I always say, I have realistic expectation. If it tracks, somewhere in the, 75 plus, 80 plus percent, total return of the underlier, I think they're doing a decent job. This one's doing right now, obviously, like, if 17% versus 35%. So this is about half. So I would say that's not a decent job. But you're taking almost all the risk, pretty much the risk on the downside, but you're leaving a lot on the table on the upside, including all the dividends combined back. But again, it's probably beating the S&P 500, but, so I'm trying to de-risk because I don't want to be so much in, and also my other thing was the performance. But I mentioned in my other video, we'll look at the chip sector. So there's a famous ticker, SMH. It's been the OG. It's been around for a lot of years now. So I pretty much, and CHPY sounds like chips because it's on the chips, semiconductors. That's what we're talking about. So it tracks out, honestly, and I mentioned in other videos, a lot better than the AI GPTY. And you can see that total return since around inception in April, it came out of this year in 2025. Total return 50. Look at the top over here, 57.22%. SMH 77.79. These are awesome returns, right? Amazing returns. And it tracks nicely. Not best that you like, but it does an okay job. But again, a lot of risk. But I want to basically show you what I did. All right, guys, here it is. So the proceeds of CHPY and GPTY that I dumped, because I put 25% into Teckle. Now you're going to ask me, number one, Teckle is a 3x leverage ETF that's been around for quite some time. Teckle, like it sounds like tech because it's like technology. It's also known as XLK. It actually doesn't have all of the Mag 7 in there. I believe it has Apple and Microsoft. It has like the more stable of the pack in there. So it doesn't pick up on all that AI. So that's a good question, and it's a fair question. And this is from Direction, came out with this ETF. And you can go ahead and compare this to SMH if you'd like, and you could see that obviously there are some correlation because technology things move a lot. And I just look at it as 3 times the energy that moves with, aggressive growth. And you could see that since inception of SMH, and Teckle came out, I think, before that. But this is like equal since like 2015-ish, before 2015, 2010-ish. This is up like 9,100%. SMH, pretty good, up 2,200. You'd be really happy with any of them. But I like this because I'm looking for capital efficiency, because I'm trying to replicate my energy that I have from GPTY and AI and CHPY. Now I have a question for you guys. Would you guys agree that CHPY only has about 75% the energy of AI, or less? Well, actually even less, 50%. But it definitely has less than 75%, for sure, if not 50%. Look at this. Look at the chart, right? 17% versus 35% total return since inception, right? So to replicate this, I need to get at least half the energy of AI. And as we saw earlier, that CHPY, was, maybe you could say maybe at least 75. It doesn't give you 100%. So I need to replicate 75% of the energy. And I feel like Teckle does that. And we can go into deep why I chose Teckle. I am also using TQQQ, and we're going to talk about that in a different video. So now that is my replication of my beta. Now that my beta is replicated, I've effectively turned myself into, 75% energy, which I've had before. Actually, before I had 100% energy on the downside and only 75% of best on the upside. Now I have 100%. I get 75% on the downside or the upside, Now GDMN, this is from Wisdom Tree. This is a stack product that gives you effective exposure to gold. It's 1.8x leverage. Let me show you. I would suggest when you go to Wisdom Tree's website, you should go on their presentation, and then this is their booklet, and then look for this page where they talk about the efficiency. So let's look over here. When it comes to so there's 2 portions. There's gold and gold miners that are built into it. So for every $100 you invest, you get $90 of effective exposure to the gold miners. They have a whole basket you can see in their ETF. And I think, by the way, their expense ratio, I believe I saw, was 45 basis points. You just double check, but I looked at it twice already recently. And then they use futures to have an efficient way to give you that leverage via futures, not swaps and all kinds of nonsense. Now, in addition, you see where it says gold futures, it says they use US listed gold future contracts, and every dollar gives you $90 exposure of gold futures. And they give you $10 of cash collateral. So you're getting, for every $100 you put in, you get, $180 worth of equity exposure. Of the $180, you get $90 of gold and $90 of gold miners. And then you get additional $10 of, treasury cash built in there, and here they spell it out really nice for you that, the actual accounting notional, accounting leverage is 1.8x leverage. That's your notional exposure, capital efficiency at its finest. So there you have line item number 2, GDMN, where that is supposed to, now Teckle is my exposure, right? So now that I've replicated my beta, now I'm working on something called alpha. Now, alpha is a term that people use also in the investor land. And alpha is not supposed to be really impressive and give you crazy returns compared to the potential of returns in equities. but it's alpha because it's excess returns on top of it. It's like getting a great salary and then getting a little bonus bump on top. That's what it's like. And the alpha, I'm looking for things that are going to be stabilizing, protecting and stabilizing my portfolio. So the alpha protects the beta and gives me a nice little bonus on top. My idea is I look at it like cash. I look at cash. I just want it to beat cash. So if it beats like whatever, the risk-free rate is 4 or 5%, it's okay in my books. Why? Because it's protecting and it should be non-correlated. The most important thing, I'm trying to make sure it's less correlated or non-correlated to my beta, which is Teckle. So GTMan is gold miners. They have their own crisis alpha. That means it's a type of alpha that can help you in crisis and hold up your portfolio. And when your equities are getting killed in a crash and gold is shining, pun intended, totally, you can use the stuff that's still hanging out there, and that could be your dry powder to potentially buy in the dip. And this is not financial advice. This is strategy that I'm thinking about. You need to do what makes sense for you and speak to your financial advisor. It could be risky with leverage stack products. It could scare a lot of people. People will wet their pants and everything. Now, I want you to look at this chart. Look at the cues. Do you guys remember the beginning of the year and then April? There was a crazy, drop in April and everything. Well, actually, everything imploded. It was a complete VIX event. So actually, gold was getting hit too. So there's nowhere to hide, really. And the gold miners have a little bit more volatility than gold itself, so they could probably fall a little harder. But the gold miners inside have gold and gold miners. So they have an internal rebalancing, an internal risk parity built inside of it, which I like. So you could see here, like year over year, this is no joke, guys. GDMN, they should call it goddamn. This is crazy. This is 190% total return. This is the year of the gold, guys. This is the year of the gold. If you think equities were high this year, you should see gold or other, international has been doing pretty well this year. And you see the Qs, 21%. But guys, come on. I would have missed this. And this is supposed to be non-correlated to equities, and this is supposed to be pretty much a protector. But it's a force to be reckoned with, and they could save my butt. If the market took a crash, I could potentially use some of this, rebalance. I mean, sell what's doing really well and use it to buy buying opportunity. So now we're up to line item number 3. Okay, now we're getting into the depth of it. So RSBA, RISPA. What on earth is RISPA? Return stack bonds and merger and arbitrage. What on earth? I just put RISPA up on the chart. It looks like it's so boring. Look at this. It's the pink or the, I don't know, purple red, whatever. It looks like it's flat as nothing, right? I mean, it's up 8.61%, right? So it's pretty much beating cash. So in my books, it's doing what it's supposed to do. Let me show you. Let's zoom in a little bit over here. So here I just put in VOO, the S&P 500 and RISPA. So you see this time in the year when S&P was getting its butt, royally kicked. Look at RISPA, sitting there like a rock, not budging, actually even going up. Like, you know what I mean? It's like when everybody's stuck in traffic, bumper to bumper after the holidays, and you're on the other side, like suckers. So RISPA is just like a rock, just moving there. And I'm not expecting it to outperform anything. I just want it to be there as a rock. So what's the secret sauce? There's 2 pieces of this build. So this is from Return Stack ETF. I swear I'm not getting sponsored or anything by them. I like their product, so that's why I'm talking about it. For now. So this is return stack. So for every $1 you put into the RISPA, you get $1 exposure to US Treasuries, and you get $1 of exposure to merger arbitrage strategy. When you talk about US strategy, you talk about the aggregate bonds, short-term, mid-term, long-term bonds, like aggregate. And then, so you're getting bond exposure and you're getting merger arbitrage. Merger arbitrage is when companies, what I understand is when companies are merging, right? There's sometimes a smaller company being bought up by a bigger company. So think of averages. If the smaller companies, let's say they're both publicly traded stocks, the smaller company may go up in price and stock to sort of match up to the higher company until they merge. And the higher company price might go down a little bit in price to kind of go down to the low. They have ways to, there's definitely some kind of arbitrage event to do, and that's what they do. So there's two types of, and that's not, the whole point is it's another way of making money in a unique way that's not correlated to the market. That's the whole point that I'm trying to bring home. And that's why RISPA gives me that like tone deaf, it's tone deaf to the market. It's like, I don't know what you're doing. I don't know. You're playing music or something. It's tone deaf. It's just, I like it. I'm just doing my thing, just beating cash, keep up with, just beat cash. That's all I wanted to do. So now I'm sitting 10% in cash-ish. I look at it like cash, not really cash, but I look at RISPA. And then I have 10% in payload, PYLD. I call it payload. That's a multi-sector bond. And this is from PIMCO. They came out in 2023. And they show that they have a good track record of actually beating in, I don't just look at trying to look for a certain tilt. I look within the tilt, what is a good quality within each tilt? If you're talking about I always talk about this, talk about growth, what type of growth? What's, what type of momentum? What type of international? What type of bonds? So if I'm talking about bonds, give me some interesting bonds. And I believe this also gives like a distribution as well. I think a monthly distribution, if I'm not mistaken. You can see here, they've been trying to beat the Bloomberg Aggregate Index, which I guess is aggregate bonds. They want to beat that. So here you got the S&P 500 against payload, right? And this is total return because they do give a little dividend. And payload, has, delivered 9%, 9.1. It's beating cash, right? It's alpha. It's not supposed to outperform the market. I already have the market represented in my energy that I have from Teckle, right? It's supposed to protect my Teckle. That's what it's supposed to do. So I made room. So but this is kind of funny that payload, which is just like a multi-sector bond, is giving you like 2/3 of the return of the market this year. You know what I mean? Like it's 9% versus the market 16%, 50, 14.5%. But it's giving you, and look at this. Maybe it went down a little bit, but look at this. It's pretty much tone deaf to whatever the heck's happening in the market. You know what I mean? It's low vol. It doesn't move much. This is how, there's a saying, it behaves like a bond. It's kind of smooth. You don't have to wake up, you're not freaking out at night, every second. It gives you peace of mind. The next 10% went to CDX. This is hedge bonds. I believe it's from Simplify. I love how Simplify has good videos to explain everything because they have very complex and very advanced strategies and they have to simplify it all. Yeah, their net expense ratio is 25 basis points. Their gross is 50 basis points. It looks like they basically do the bonds, but they also do like some kind of long short. So like long, I think, quality and short junk. And they have like this arbitrage in there. And guess what? You still get monthly payments. You got my 15 cents per share payments every month. Consistently, they've been paying out pretty nicely. Now I can look at the chart of CDX, which returned 8%, 8.2% total return year over year. And like I said, it's just supposed to keep my cash safe, beat cash. Beat cash, keep portfolios safe. Don't lose money. Protect my beta. And you can see there was some kind of crazy choppiness during that whole liberation thing. They were, I don't know what they were doing there. That seems like a Six Flags Great Adventure theme park right there. That's not Bond-ish. And yeah, that's there. And then finally, the next line item, 10% went to event. So an event, think of like corporate events. It could be liquidations, it could be changes in corporations, it could be merger arbitrage. Not necessarily. It isn't the merger arbitrage like domain, of course. And they decide what they're going to long, what they're going to short. They came out, it looks like December 31st, 2014. They do have a hefty expense ratio of 1.33 percent. And it's advised by the advisory team. They have focus of this little aspect of the market for more than 20 years. So this is like their area, their corner. So here they have a good explanation. While the fund may invest in a wide array of corporate events such as mergers and acquisitions, spin-offs, restructurings, refinancings, and more, with both hard catalysts, which tend to be characterized by more definitive outcomes, shorter timelines, and lower levels of volatility, and soft catalysts, which tend to be characterized by less definitive outcomes, longer timelines, and greater levels of volatility through also greater commensurate return. The advisor expects to focus primarily on hard catalyst opportunities, particularly merger arbitrage. So it seems like that's the main focus, merger arbitrage, but it also encompasses beyond that. Now, if I'm putting you to sleep with these low yield charts, that's actually the point. Because if I'm putting you to sleep, the chances are I'm putting myself to sleep. This way, AKA, I get to sleep being invested in the market, knowing that about 50% of my holding, I'm in cash. I'm sitting 50% in cash. And you can see here, event, year over year total return delivered, is beating cash, 12.86%. If my bank gave me 12.86%, I think everybody would be lining up for the bank for 12.86%. You do take a little risk, but I look at it like a cash equivalent. That's how I look at it. It has a little bit more of the volatility than the other stuff that I showed you. But you can see it wasn't affected. It did have some correlation, but the drawdown was much less, as you guys can see. And then the remaining 10% literally is just sitting offsetting margin. So I've reduced my margin a little bit as well. So I'm trying to go down on my margin a little bit. So let's look over here at exposure, and then we'll pull up the portfolio visualizer, and I'll show you how crazy these things are. So before, I only had 100% to give. I don't have more than 100%. It's like I don't have more than 24 hours in the day, right? But here I've expanded with all this leverage and stacked, I've expanded my portfolio up to 180%. Hopefully, I'm expanding your mind over here. So before, my exposure was like a donkey, 100% AI chips tech. I was fully in, but I only had I had the energy of 75% for the upside at the best. Remember, you saw GPTY, barely 50. At best, 75. But for the downside, yeah, fully there to participate for the downside, 100%. So yeah, sometimes it's hard to sleep at night when you're all in and you're participating 100% on the down, and on the up, you're only participating up to 75%, what it seems like. Now I have, like I said, the 180% expanded portfolio. My exposure to tech chips, well, and you're right. There is Soxel, which is triple leverage, semiconductors, which is probably more appropriate correlation. But I'm looking at I have other reasons for this, but I still effectively have 75% into the market. I also have 22.5% in gold exposure. You could do the math, 0.9 times 25, because 25% was gold, 0.9, 22.5. But anyways, 22.5% in gold mining. And we learned also that they also have 10% in treasury. So that's 10% of 25%. So, you know what I mean? So it's like 2.5% in extra, just treasury on the side. I have 10% in merger arbitrage. I have 10% in US bonds blend, right? 10% in multisector bonds, 10% in hedge bonds, 10% in corporate events, and 10% in cash, aka paying down my margin, less expenses, less cost to carry. So I ask you guys a question. Who would sleep better at night and not get sick? Somebody all in, or somebody getting the exposure of all in? The market's up, you capture it. The market's down, you're sitting with a sack full of dry powder right there. And I have the data to back it up. Let me show you. So let's talk about portfolio number one, which is my original, not my entire portfolio, but that's what I had in my portfolio, CHPY and GPTY. They were equally weighted, so I just did a portfolio of 50-50, right? And somebody moving it over to portfolio number two, which is the newer one where I've moved towards, and that's 25% TECL, 25% GDMN, 10% CDX, 10% payload, 10% RISBA, 10% event, and 10% US cash, whatever you want to call it. It's like cash, paying off margin, right? And let's go ahead and look at the report card. I'm actually comparing it to the Qs. So I'm trying to let's just use the tech as the benchmark. And very important, always remember to look at the timeline. That's very important. So some of the funds are newer, so they can't go further back to back test it. So this is just back testing only from May to October. So it's 6 months, because I think it goes from the beginning of May to the end of October. So it's about 6 months worth of, half a year worth of data. So it's not, put that into perspective before you jump to too many conclusions. So let's say you started with 10K 6 months ago, and you put 10 grand into each of these portfolios, you have three options, and you pick one of these options, you would end up, portfolio 2 is the enhanced one that I changed it to, that's the one with all the, where I am right now. I would actually have more money than the yield max in my account with all the dividends put in. So I have 15,960. And you remember, some of the stuff actually, like Payload and CDX, they pay me dividends, but not, but real dividends that I can actually use. It's not as exciting, but it's real. The return, you could see here, portfolio, obviously 50% return is crazy. These 6 months have been nuts. Like, the NASDAQ is up 32%. That alone is crazy. 32% up in a 6 month period is nuts, even for the NASDAQ. But, this is like double the NASDAQ. This is 59%. It's almost double. And the CHPY and GPTY, not bad. 50%. It's amazing. Nothing you cannot This is like good versus great. Standard deviation. Look at this. I have a triple leverage product in my portfolio. That is my beta that I've replicated the energy. And I have a standard deviation. And again, it's only 6 months worth of data, so I don't know. 15.24%. The NASDAQ, I don't buy it because I know the S&P 500, historically, if you could backtest in many years, is around 15%. I don't buy that the NASDAQ, which is more volatile than the S&P, is less than that. So, whatever. The point is that this portfolio has less standard deviation than the yield max ones. Maximum drawdown, the market was just pumping for those 6 months, so it's hard to say. And then the sharp search, again, this has the highest sharp. We don't really have much data for this Sortino. But look at this over here in the bottom. This is very important for long-term understanding. Benchmark correlation. With CHPY GPTY, I was like almost perfectly correlated. I was 94% correlated to the NASDAQ or the S&P. They're pretty much in the same, liquidity bucket. But here, I'm only 0.51 in this time frame. So I'm even though I have the energy of the the market of X, I'm only 51 because I have all these diversifiers in there, and I'm sitting pretty much like you guys saw, 50% cash ish, cash equivalents, alternatives, stuff like that, etc. And so you can see how smooth this is. But we can back, over time you can back test different products over longer periods of time. So the point is, that's why I'm going towards something like the golden butterfly, or the permanent portfolio, or the all-weather portfolio, whatever you want to call it. The bottom line is, it has a lot of cash, or cash equivalents, or bonds, whatever you want to call it. It's got some gold in there, or there's also going to be trend, global macro, and there's also managed futures. There's a lot of layers of complexity. Mine is like really complex, and U.S. stocks. So but I don't want to miss out on the momentum of, let's say, the NASDAQ or the S&P. So I want to replicate that. I'm going to take advantage of, leverage products and stack products in a smart way to make room for other stuff that are going to stabilize it. You're going to ask me in my comments, oh my God, the working investor, what's going on with volatility decay, path dependency? Yes, I'm aware of that. And that's what rebalancing is for, which can help somewhat mitigate it. Of course, in a crisis, in a pure VIX event, everything just goes to SHIT. You know what I mean? That could be tough. But I'm sure there could be something in there that could help. But the things tend to bounce back, I've noticed. But of course, past performance is not indicative of future gains. Things do tend to bounce back, but the impact obviously would be harder. The delta, the amount that, very, AI bubbly stuff would fall, or Bitcoin stuff would fall, would probably be much greater potentially than things that have low vol, uncorrelated. Those things may not fall to the same impact. So you still can have some kind of, arbitrage, some way to sell something to make some money to buy something cheaper if you'd want to, and take opportunity. Anyways, let me know what you guys think. This is a little bit of a longer format video. Hope you guys are having a wonderful Thanksgiving. I'm thankful for all my subscribers, and I really appreciate you guys. Be well and have a wonderful and blessed year. Take care.